Like every other state, Trinidad and Tobago has a tax regime as one of its main sources of government revenue. A Trinbagonian, like citizens of other nations, pays direct and indirect taxes, in the form of income tax and consumption taxes, most commonly the VAT, both of which will be covered in this video. We should first go over some key terms that will be used to help you understand and discuss these taxes. First, we have the taxpayer. For the purposes of this video, our taxpayer would be a middle-income Trinbagonian citizen in a well-off position within the corporate sphere. And then we have tax base. This is what is going to be taxed. For example, property, a transaction, or any activity which incurs the additional payment of a tax. The definition of these bases and their respective rates are specified by legislation, such as the Income Tax Act, the Value Added Tax Act, the Miscellaneous Taxes Act, the Customs Act and subsequent legal notices, and the Property Tax Act, to name those that we be dealing with. These acts govern and regulate the tax bases and payers, as well as how the regime functions, for instance, through accounting and the pay system. Before we dive into our example of how the tax regime functions for our hypothetical Trinbagonian, we must be clear that this video is purely for entertainment and educational purposes. Viewers should always consult with registered professionals instead of taking action based on any information presented in this video. BigOnTax is not responsible for any action or results based on information or errors provided in this video. Having covered some key terms, we can move on to defining our hypothetical middle-income Trinbagonian. According to the CSO's Household Budgetary Survey in 2008 and 9, the average Trinbagonian earned roughly $9,201 monthly. But this information is outdated. While another survey is being prepared for 2022, we'll use another calculation. One important side note, which is crucial to discussing tax. Our Trinbagonian is a citizen of Trinidad and Tobago only. That is, he earns income domestically alone, and the extent of his cross-border transactions are limited to online purchases through a skybox. Now getting back to it, this Trinbagonian we'll call Bob. He works a skilled, middle-income job somewhere in lower-middle corporate management. We won't speak about his self-employed business-owning friend Joe, because Joe's got more complex taxes to file, and we need to keep this video relatable. To figure out his income, let's say Bob takes out a mortgage for $1.5 million to purchase his first home. Let's use the TTMF mortgage calculator and the assumption that Bob contributes 1/3 of his gross income to paying off his mortgage. So Bob's $1.5 million 30-year loan at 5% interest demands a monthly installment of $7,650. Since he contributes 1/3 of his gross income, Bob would be earning $22,950 monthly in gross income, and annually $275,400. We'll use this annual figure to illustrate how the taxes work. First, let's talk about his direct taxes, which take the form of income tax, national insurance service contributions, and the health surcharge. Another direct tax that would be accounted for in Bob's returns later on is the new property tax. There are significant moves being made towards the establishment of a regime for this, but we could talk about this in a later video. Income tax, defined by its act, is based on your taxable income, which is determined after calculating deductions within a return, and can be further reduced by benefiting from tax credits. There are basic rates. For those with taxable income under $1 million, the rate is 25%, and for those above, the rate is 30%. The Act also specifies a personal allowance, which has recently been increased from $84,000 to $90,000, meaning that anyone earning a gross income of $7,500 a month is exempt from income tax. So Bob earns less than $1 million annually, and will have his taxable income subject to a rate of 25%. In terms of his NIS contributions and health surcharge, since Bob's income falls within the highest rate levels, he'll be paying the maximum rates of $6,628 annually for NIS, which is about $552 monthly, and $396 annually for his health surcharge, which is $33 monthly. Now let's calculate Bob's deductions, filed in TD1 and TD4 forms and their supplements. First, Bob can apply a first-time homeowner's allowance, a $30,000 reduction in his assessable income. At this stage, he can also apply a tertiary education expense deduction and covenanted donations. Next, he applies the personal allowance, $90,000. We arrive at his assessable income of $155,400. From this, he may have further deductions to consider before we ultimately reach his income tax liability. We can apply, if he had any, his contributions to an approved pension plan or scheme, or a deferred annuity plan. We also deduct 70% of his NIS payments, a total of $4,640. Both of these deductions are capped at a combined $30,000. Next, we could apply, if he had any, a deduction equal to his alimony or maintenance payments. So Bob's total deductions at this point are $4,640, and we're finally at his chargeable income of $150,760. At the less than $1 million rate of 25%, his liability is $37,690. At this point in filing his taxes, Bob can make use of tax credits, which may arise from the installation of a CNG kit or solar panels, both capped at $10,000, as well as a credit of 25% of the face value of national tax-free bonds or the value of purchase of venture capital shares. Since Bob has none of these credits, his liability remains $37,690. The total contributions paid by Bob include his tax liability, his NIS, and health surcharge payments, and this totals $44,714. And at the end of the day, Bob nets $230,686. This brings us to the close of our look at direct taxes. Be sure to take a look at part 2 of Trinidad's taxes for an individual, where we'll cover the indirect taxes as well as work out a minimum figure of how much Bob pays in taxes overall.